Welcome to ADU Point, a video series dedicated to accessory dwelling units. Hi, my name's Will Johnson. I'm a renovation loan consultant and ADU advisor. We're excited about accessory dwelling units. The new ordinances in 2020 has really removed a lot of major barriers. Combine that with financing. This will really empower homeowners to develop affordable housing for loved ones or create an attractive income stream. That's the good news, but there is a tale of caution. This is a complex, dynamic, evolving process. Selection of resources are critical. We've learned a lot with every ADU that we've built. So we'll interview key experts and ask probing questions around ADUs. We'll talk to architects, contractors, builders, interior designers. We'll also talk to financial specialists to understand the best financing that meets your needs. We're committed to advancing your ideas into action. So connect with us and get all of your questions answered. So let's get started. One of the key benefits with these new ADU ordinances is it's actually creating a very attractive investment opportunity. And I see two strategies, one for creating equity and another one to create a passive income flow. So we really wanted to talk to some experts today, and I'm delighted we have a key expert with us here today that really understands the construction industry, investment opportunities, and has a real estate company. So I wanted to introduce Henish Pulakal with Cal Home Co. Henish, thank you for joining us today.
Thanks for having me on, Will. I'm excited to be on the show.
Great. Well, thanks so much. So I asked Henish to join us today because he's a real estate investor. We're just talking about an investment opportunity he has with us, or he has today out there. And he has also a construction company that does a lot of work specifically in ADU. So Henish, could you just sort of walk us through the numbers and help us understand how you approach real estate investments in general and how this might apply to accessory dwelling units?
Yeah, and this varies for each person and their criteria, and most importantly, access to financing and or cash. With the investment properties that I've been working on, mostly we've been doing the quick flip and fix and flip. We call them investment remodels because we don't do them cheap or quickly or just put lipstick on a pig. We're doing full remodels that are done properly, typically permitted with everything done properly. So in that case, the numbers are just kind of working backwards from the exit plan, right? I figure out how much a property will sell for. I figure out how much it'll cost me to fix it, figure out what the holding costs are and the sale costs, and then I work backwards to a price. If that works for the seller, then it works for everyone. So if it doesn't,
do you ever use cap rates in your valuation or cash on cash kind of evaluation?
Not for flips, but I do for rental properties.
Okay.
Right?
Okay.
So for rental properties, understanding cap rates, and then also the other aspects of real estate is important. What I'm finding though with ADUs specifically is that people try to make it a one-step equation, right? An ADU costs $100,000 and I think it can only make $1,000 in rent, and I don't know if that's worth it, right? And I had this exact conversation with a group of realtors just last week when they did that exact calculation. They figured it would cost $100,000 to convert their two-car garage, and they thought that they would only make about $1,200 to rent that garage conversion in their part of town. So when they did the math on that linear one-line equation, they're like, this doesn't make sense for us. And so I told them some things about asset reallocation, cost segregation, and accelerated depreciation, and how that changes the equation from a one-step equation to about a five-step equation. And so what they said is probably true of most people, even in the real estate industry, which is I didn't even know those things existed or to even ask those kind of questions to understand that, right? Which is kind of investing 102, right? Investing 101 is buy a house, it rents for this, cool, that makes sense, right? But with ADUs, because can be classified as a separate property, even if it is attached, you can take different write-offs that people aren't aware of with their typical residences or even their rental properties, right? Part of the reason is because cost segregation is typically a tactic that's done by people that are commercial investors for their commercial properties,
Okay.
for retail space, for commercial space. But what they don't understand is that you can do the same thing for your residential properties, right? And so
Excellent.
in some
Okay.
cases, when I've talked to financial advisors, including my own, the concern is that cost segregation reports can cost several $1,000s, and is it worth it? Well, I told him, I was like, hey, if I can get a cost segregation report done for $1,000, is it worth it? And he said 100%, right? So it was absolutely, totally worth it if you can get it done affordably. If you can't get it done affordably, it might not be worth the return on investment to pay for it. But from
So
what
are
I'm
we
finding,
really looking at sort of depreciating these different assets? Is that sort of what we're talking about?
yeah, so a lot of people do understand that they can depreciate a real estate property over 27 and a half years. So a simple basis is, let's say the house is worth $275,000. If they take a straight line depreciation over 27 and a half years, they could depreciate $1,000 a year, right?
I
And that
see.
means you
Yeah.
could write that off of your taxes as the depreciable part, because the remaining economic use of the property decreases every year, right? Because if you build a structure after 27 and a half years, you're going to have to do significant improvements to hopefully make it last another 27 and a half years, is kind of the thinking, at least from the tax basis portion, right?
Right.
That's how the IRS believes it is going on. So on here is some of this is my actual data for my ADU, which you can see in the
Right.
background of this picture.
Yeah.
That's my 2-story garage conversion ADU over in Pacific Beach. And so on the top left, those numbers there are the actual cost segregation report numbers that I rounded off to the nearest $100, so we can kind of get some numbers of what this looks like. So the ADU itself, the structure, I would estimate would have cost about $250,000 to $270,000 to build it from ground up, if I had built it from ground up. Fortunately, in this case, I had bought the structure and I just had to remodel some of it. But I still paid for the cost segregation report, which in this case cost me $1,000. And in this
Oh.
report, it shows that the structure itself is $185,000 over 27 and a half years, which comes to $561 a month, roughly. Right. With the furniture, you're saying they took a look at the pictures. They saved themselves a trip out there and said, yeah, your furniture is worth about $13,300, which divided by a 5-year lifetime comes to about $222 a month. Okay.
Okay.
The fixtures, which includes the light fixtures, the plumbing fixtures, any other kind of improvements like that, is a 7-year depreciable thing, which is another $154 a month. And then the land improvements, which would include the concrete, the connections to utility, the grading, the landscaping around your house, has a 15-year life, and that's $124 a month. So now my depreciation comes to a little over $1,000 a month, or a little over $12,000 per year for my structure, right? So that's pretty significant, because in the next chart on the right side, and this is where I deviated from my actual property, because I live near the beach, the rent that I get is significantly higher than someone that lives anywhere else in San Diego. So in this
Sure.
case, I used an average rent of $2,060 per month for a 2-bedroom space in San Diego, which comes to almost $25,000 a year. And so just looking at that over the cost of the structure, that came to about a 12.4% cap rate. But now if you take a look at my depreciation, right, that $12,717, I can write off of my ordinary income. And I'm assuming at a 30% tax bracket, that shows me at a loss of $3,600 per year on just my depreciation.
Okay. There's a couple more charts here. I don't know if that's related to what you're talking about, but just a comment, cap rates in general that, real estate investors look at run much, much lower. So I think those cap rates are going to look very, very attractive. And I think largely to do because of this whole depreciation that you're taking into consideration.
True, that's all a strong factor, right? So for the most part, and you've seen this, is that commercial real estate or anything that's a 5-unit or more typically trades at like a 4 or 5% cap rate.
Right.
And so when people talk about investing, a lot of investors that are saying, hey, I want to buy units or I want to buy houses, they typically say, well, I guess I'm going to have to end up buying in Arizona or Tennessee so I can get an 8, 9, 10% cap rate. But then you get a lot of uncertainty, and you get the issue that every time there's a leaky toilet, you got to spend $100 to get a plumber out there, as opposed to maybe you can go out there and fix it in 10 minutes, right? So
Yeah.
there's a lot of value in having real estate in your own backyard on land you own, or in
No
the
kidding.
airspace above your garage, because that increases your cap rate at least threefold in most cases, right? Instead of a 4% cap rate of buying a separate asset here in San Diego, or instead of getting a 10% cap rate in a separate state, you could do this in your own backyard and get the kind of cap rates that people dream about with investing out of state. Right. So now when you
Excellent.
factor in writing off your operating expenses, which in my case came to about $1,300 a month, and writing off the depreciation, which in this case came to about $1,000 a month, I'm showing a loss of $300 a month, assuming my $2,000 monthly rent, right? In my case, like I said, I get significantly higher rent than that because I live close to the beach. But
Sure.
in most cases, people would still be able to show a significant loss when at the end of the day, if you pop up the next chart, you'll see that you're getting the cash flow, right? You're getting the cash. It's just that for the IRS purposes, for tax purposes, you can show a loss.
Let's bring up the next chart.
So you can bring up, so now you're keeping a lot more cash. So of your gross rent of almost $25,000, you're keeping $9,000 of it, right? And the rest goes to expenses, but that's a huge amount considering that now that's net cash flow, even net of your taxes, right? So now the question is, that's another $700-800 a month is, and that's net of your debt service, right? You've already paid your mortgage, you're paying your taxes, you're paying your maintenance costs, your utility bills, you're already factoring off depreciation, and you're still keep taking home that much cash after all those expenses are paid. Right.
Yeah,
So
I
now
tell
a
you.
lot of times when I go through this, a lot of times this does look like a foreign language to a lot of people because numbers and charts can be confusing. But once you start playing with it and realizing it, this, as I mentioned at the beginning, this isn't a one-step equation.
Yeah.
An ADU costs X, my rent is Y. I don't know if that makes sense, right? Because you have to factor in your operating expenses. You have to do some depreciation. You have to figure out what your cap rate is versus other alternative investments, or putting your money in a bank account or a savings account or getting a 5% yield on a mutual fund. Also, this doesn't even factor in the appreciation that we get in San Diego real estate, right? The fact that you can build some one of these things and get so much instant equity that a buyer would be willing to pay a premium over what you paid to construct one of these things in your backyard or convert your garage. It's a hugely compelling argument. And once I do this either verbally or on paper with any potential client, the question quickly goes, how can I afford this, to how could I not afford to do this, right? Because who doesn't want an extra $700, $800, or $1,000 per month in their pocket, net of taxes, every month?
Well, I mean, that's the exciting part for me is, these are about as attractive as these numbers can get from, overall investment standpoint. But, it's so exciting that, this really sort of empowers homeowners in general, that they actually can do this. They can actually create affordable housing for family members, and then alternatively see this as a great investment strategy. I mean, I think we need to be diversified. We can't have all our money in the stock market. I've learned that the hard way. So I just really like this, that this really empowers almost every homeowner, with all of the new ordinances that are available right now, to do this with financing. So this is just really great, attractive information. So Henish, thanks so much. How can we best get in contact with you for any kind of a follow-up opportunities?
Yeah, any of these options is fine. I'm happy to take phone calls, texts. That's my cell phone that's on there, and that's also my personal direct email to my company account. And then we have a cool showroom here in Bayho, West Claremont, over on Marina Boulevard. So we're typically here, 9 to 5 on most days. So make an appointment, come visit us, and we can help spec out your ADU. And I'm happy to go over some of these numbers, at least in broad strokes, with you. I'd always advise you to talk to your tax professional or your accountant to kind of verify these numbers, which they will in fact do because they understand how this works. So that's the nice thing, because I ran this by several professionals and they're like, yep, this works. And we had a delay doing this presentation because I personally just did my taxes last week to confirm these numbers, and that they're going to fly with the IRS, and I'm not going to have an audit issue and the men in black knocking on my door.
Wonderful. Well, it's a pleasure working with you. I know you're always accessible, and that's what I really appreciate, that you are accessible. You return phone calls, respond to emails. That really means a lot to me, and it really just shows your level of professionalism. So I want to thank you for all of the follow-up that you do and take care of a lot of customers that I have. We have a couple of just additional references to talk about. I manage a ADU Facebook group, and really want to encourage you to sign up, join. There's a lot of professionals on there. Henish is answering a lot of questions on there, so I always appreciate that. But this is a great opportunity to get your questions asked, get exposure to a lot of professionals, share your project. And then I also have a website for renovation loans, SD203K. I have a whole section dedicated to accessory dwelling units. A lot of good information about all of the financing options that are available. I also have all of the current ordinances on there. I have copies of all of the master plans, so it's a good one-stop shop there. So again, Henish, I wanted to thank you for joining us today. Look forward to working with you, and keep up the great work. I appreciate it.
Hey, thanks so much for having me on the show. It's always interesting. I'm always excited to share this because I think it's so good. Even if I didn't personally benefit, I want people to take advantage of these things. I'm sure you do too, because it can be such a help to their family. And that's what we're finding. About half of these end up getting built for people that are trying to house their family. So please do
Yeah.
so. This is a huge tool that we have. And we're fortunate that the state has allowed us to push for these, because it's a huge opportunity.
Yeah, amen. I couldn't agree more. Thanks again, Henish.